Welcome investors, and thanks for joining us on your Investment Advisor channel, where we decipher the markets so you can make actionable investment steps. I'm Jake Ackerman. Stocks continue their decline, energy rises, rates continue to rise, and China stocks surge. So what's going on? Well, we had a terrific January, one of the best Januaries we've seen in many, many years, and stocks don't go all up at once. So with that being said, stocks have pulled back. It had a really nice January. Energy had a massive decline since June of 2022. And right now it's been essentially consolidating for the last few months. China stocks have really taken off these last few trading days, and it looks like they're continuing to loosen their COVID policy, a little bit better than expected economic data. They still have quite a bit of issues to work out, but the markets are going to be forward-looking, and 2022 and 2021 for China stocks was a fairly big wipeout across the board for the majority of their stocks, especially their tech. Their tech companies had a big crackdown with their policy of trying to squeeze and maintain power with their government, but that's a whole different issue, talking about the Communist Party of China. But we're looking to make money here and find opportunities for you. So China stocks look like they are having some really nice upside potential. Plus, we're seeing a large institutional inflows of money into those stocks as well. So when do those play out? It looks like they're playing out here as we speak, but there's still a lot of headwinds, potential downside risks to it, and that would be continuing COVID crackdowns, more regulations against their businesses. That's always kind of an issue with China that we see, especially since 2022 or 2020 with COVID being released into the world. Inflation. Let's talk about inflation. Inflation has been on the decline since June of last year, and we've had spikes. We've definitely had spikes because, again, no markets don't go down in a straight line, and we had a spike in inflation in January. And if you look historically, seasonally, Januaries are higher inflationary points because a lot of businesses raise their prices during that month. And we've seen seniors' Social Security benefits go up over 5% in January. That hit. That's a wealth effect where you have more money to spend. Your habits are still the same of expenses, and you saving that hasn't translated yet. So that's seasonally, the first quarter of a year has higher inflation. So as we continue to progress, the way that they change the weights of how we tabulate inflation data reports, plus the seasonality, what I'm seeing right now is, and what we're seeing right now is the continuation of the decline in inflation. Now, services are still sticky, so the more volatile pieces of the index are coming down. So that's good news for the markets at this point, but we do have to watch the bond market. With rates spiking, bond prices are coming down. The bond traders have been very good investors, painting the picture of where the markets are going to go. So as bond traders, as you see the bond market continue to decline because rates are rising, that is a warning sign. But right now, we are still at good prices. The bond markets are slowly rising, but it's still within it's still below the recent high in 2022. So we're still okay there, but that's something to monitor for us going forward. So what's going on next week is unemployment report. That's going to be another report that could bring the market a lot of volatility. A lot of investors are going to be watching that report. We need to see signs that the rate-raising campaigns by the Fed is having the effect that they are looking for, which is, unfortunately, they want to see some people lose their jobs, unfortunately, and they want to see inflation to continue to decline. So we had that spike, and that's why we're seeing the pullback in the markets, for one, and number two, is things don't go straight up, so we're seeing a pullback in prices. But we need more follow through. We need more follow through for this bull market to continue. But right now, when I say bull market to continue, we're still in a longer term bull market. We did have a bear market last year, technically speaking, and prices have started to shift with bullish momentum. Bullish, up, bearish, down. So we've seen it shift to this bullish momentum. Now, for that to stay, we need a sign that inflation is dissipating, continue to dissipate. And one of the first signals is unemployment probably going to go up because businesses are tightening down the hatchet because their prices have increased, and they need to continue to return value to their shareholders in the form of higher stock prices. That's their fiduciary responsibility. So if we see it translate into there, that's a successful sign. The Fed is winning, and the next inflation report is right before the Fed meeting. That's March 14th. Now that is going to be a deciding factor of what we believe a deciding factor of 25 basis points or a 50 basis point hike. It will likely depend on these potential two data points. And right now, we are hearing the Fed come out on the news stations and channels and during their conferences, and they're continuing to sound hawkish. We would expect them to sound hawkish. They don't want to loosen monetary policy, so we would expect them to remain verbally hawkish. But as Fed Chief Jerome Powell stated, they're going to be data dependent. Even James Bullard, the most hawkish member of the Fed board, said we're getting close to where they want their terminal rate. But again, they're going to be data dependent. So what are we going to do? We are going to watch the data come in, and we are going to make our investment decisions, and we will change accordingly if necessary. So tune in after these next employment rate is released on Friday, and we will discuss and give you our opinion and where we're expecting the markets to go. Expertise you deserve, experience you can count on. Jake Ackerman.